Money. Money.
I am very happy to share that there is no change to mortgage interest deduction in the Trump tax plan. U.S. Treasury Secretary Steven Mnuchin said on Wednesday the Trump administration tax reform plan will not change the deductible of mortgage interest and charitable contributions. Mnuchin was quoted saying, "Let me first clarify. We are not taking away the charitable deduction and we are leaving the mortgage interest deduction as is." This was in an interview on Fox Business Network. On December 1st, prior to President Donald Trump taking office, Mnuchin told CNBC that Trump wanted to cap the amount of mortgage interest that taxpayers conduct. It has already been capped at what capped. I'm going to talk to you about that in a second. But Trump, in his speech to Congress on Tuesday night, said he wanted to provide massive tax relief to the middle class and cut corporate tax rates. But he did not offer specifics. Mnuchin said he expects the tax reform plan to be passed by Congress and signed by the president by August. Trump has said that tax reform should reduce the tax rates for individuals and businesses, do away with longstanding tax loopholes, and broken the tax base in order to drive U.S. economic growth. So if you're renting or thinking of homeownership, the tax write-off is staying and can be substantial. Interest deduction is one of the most popular U.S. tax deductions and mortgage interest rate deduction. It's also a stimulus to buying a home. As a taxpayer, you must elect to itemize deductions, and the total itemized deductions must exceed the standard deduction. Otherwise, itemized would not be reduce the tax. So currently, the deduction, principal residence and second home, not for investment, but there are other benefits to investors out there with negative rents and other things that you can write off. The second is up to 100,000 home equity loans if used to improve your home. Third, taxpayers are only eligible for this deduction if they itemize. And last, the interest deduction is capped at $1 million for married filing income taxes jointly and $500,000 if you are filing separately. This is the largest house-related subsidy in the U.S. tax code and reduced income tax revenue by more than $100 billion each year. Now, you want to make sure that you talk with a tax advisor, because I'm a mortgage professional, to understand exactly how this is going to benefit you. But the deduction has been around in some form or another since 1913. Homeownership is the heart of the economy. Healthy real estate market equals a stronger employment market. If you're listening to the show today and you're thinking of renting versus buying, my advice is maybe think again. Real estate is the only investment that you do. If you don't participate in, you're going to have to pay in some way. And we know what that is. That's rent. So if we take a look and just compare, if we had a rent payment of $1,500, you've got a roof over your head, but the money's gone. You're not getting any type of benefit for that outside of that 30 days. On a mortgage, $1,500 mortgage payment, let's just say you're in a tax bracket of 25%. So you add 25%, that equals $1,875 in a mortgage. Now, what you can do is you can amend your W-4 with your employer so you can realize that tax benefit in your net income, your take-home net income every month, rather than waiting to the end of the year to see that benefit in less income taxes. I prefer to do this because I don't want the government collecting interest on my money. Now, another benefit of mortgage is it's fixed. Principal and interest payment is fixed. Your taxes obviously are going to increase as your property value increases. When the property values decrease, your property taxes will go down, and there can be adjustments to the homeowner's insurance as well. But other than that, if you're on a 30-year fixed rate mortgage, that is a fixed rate payment. Also, part of that payment, the portion that you're applying towards principal, is actually going in to the equity of your home or a home bank account that you've got that when you sell your home. Rent payment is not fixed. It's going to increase depending on what's happening in the market, but increase on an average 5% a year. So if rents just kept up with inflation, average annual increase would be 3.2%. So a $1,500 rent payment would cost nearly $900,000 over 30 years. That $1,500 mortgage payment would only be $540,000 over 30 years. No increase with inflation. Now, yes, you have property taxes and insurance, but we talked about that tax benefit of homeownership. So majority of the time that tax benefit is actually going to be taking care of your taxes and insurance. So we can kind of wash that out with that. So the homeowner at the end of 30 years will have no mortgage payment. And with just a very small appreciation of just 1% over 30 years on a $300,000 property, you would have, with compound interest, over a $100,000 nest egg for retirement. Historically, real estate doubles every 10 years. This is just over 7% average a year. On top of that, owners who live in their property 2 out of the past 5 years who have equity and sell their primary residence receive a capital gain exclusion of $250,000. If married, $500,000. Where else can you get a tax break on the investment and then receive proceeds tax-free? I can't think of any other investment that works like real estate. Now, that renter, on the other hand, in 30 years has no equity in their home, paid $360,000 more to live. And here's the scary thing, no payment end in sight. So if you're not buying because you're worried about the investment not appreciating, the bigger nightmare is not being able to continue to afford your rent because of inflation. So just look at appreciation as an added bonus. If there were no appreciation, would you be a homeowner and comparing rent with no payment end versus being a homeowner and having a fixed payment and having some type of tax benefit? That's my money chat for you today. Coming up next on the Money Hour, conversation with Denise Lonis with the Lonis Group. Facts and insights on the topic of what's happening in 2017. How will home prices and inventory change? And what will the hot topics be in real estate? Right here at 1150 AM KKNW after the short break.